The RBI just dropped a bombshell. All right, folks, listen up because this is big. The Reserve Bank of India, the big kahuna of the Indian economy, just came out of nowhere and dropped a bombshell on the market. I'm talking a surprise move, a real shocker. They've slashed the repo rate by a whopping 50 basis points. And as if that wasn't enough to get your blood pumping, they took a sledgehammer to the cash reserve ratio, CRR, cutting it by 100 basis points. That's not a haircut, my friends. That's a full-on buzz cut. This is the kind of aggressive, pedal-to-the-metal action we've been waiting for. The market went absolutely bonkers. The second the news hit the wires, the Sensex, the Nifty, they didn't just climb, they rocketed. We saw green arrows everywhere. Traders were cheering. Phones were ringing off the hook. This is what happens when you inject pure, unadulterated rocket fuel into the veins of the economy. It's a tidal wave of liquidity, a green light for growth, and a signal that the RBI is ready to play ball. Money, money, money. But hold your horses. Don't just jump in with both feet. When the central bank makes a move this massive, it creates winners and losers. So, what does this mean for you? For your wallet, your job, your investments, your future? That's what we're here to break down. We're going to peel back the layers of this onion, look at the good, the bad, and the downright ugly. We'll talk about jobs, loans, stocks, and the silent killer that is inflation. Are you ready to make some money? Or are you at risk of getting run over? Stick with me because we're going from chaos to clarity. Let's get into it. Booyah! First things first, let's talk about what really matters to Main Street, not just Dalal Street. Jobs, paychecks, putting food on the table. When the RBI cuts rates like this, it's like giving every business in the country a shot of adrenaline. Think about it. The cost of borrowing money just went down. That factory owner who was on the fence about buying new machinery, he's making the call. That startup founder who needed a loan to hire 3 new coders, she's at the bank. This is the grease that lubricates the gears of commerce. This isn't some academic theory, people. This is real life. Lower interest rates mean businesses can expand their operations, open new locations, and invest in growth without getting crushed by debt payments. And what does all that expansion lead to? Say it with me. More jobs. We're talking about more factory workers, more software developers, more truck drivers, more sales reps. This move is a direct stimulus aimed at getting people back to work and boosting the entire economic engine. It's a bet on the Indian entrepreneur, and I'm telling you, that's a bet I like to make every single time. Kaching! All right, let's bring it home. What does this mean for your personal bank account? I'm talking about your disposable income, the money you have left over after you pay the bills. When the repo rate gets the axe, the banks, if they're smart, will follow suit. Your EMIs, those pesky monthly payments on your home loan, your car loan, your personal loans, they're heading down. This isn't chump change. This is real, tangible cash being put back into your wallet every single month. Imagine what you can do with that extra money. You can finally take that vacation, buy that new TV, or, and this is what I want you to do, invest it. This is a direct boost to consumer spending power. When people have more money, they spend more money. They go out to eat, they buy new clothes, they upgrade their phones. This creates a virtuous cycle of demand that fuels businesses, which in turn leads to, you guessed it, more jobs. It's a beautiful thing. The RBI just gave you a raise, so don't just let it sit there. Listen to me. This is the sale of the century, and it's happening at your local bank. Loans are about to get cheaper. Cheaper! I'm screaming it because you need to understand the magnitude of this opportunity. That dream house you've been eyeing? The mortgage just became more affordable? That new car you need to get to your new job? The auto loan just got a discount. Are you a small business owner? A titan of industry in the making? The cost of capital, the lifeblood of your enterprise, just got slashed. This is the time to be bold. The banks are going to be flooded with this cheap money from the RBI, and they have to lend it out to make their own profits. They'll be competing for your business. This means better terms, lower processing fees, and most importantly, lower interest rates across the board. If you've been sitting on the sidelines, waiting for the right moment to make a big-ticket purchase or invest in your business, the starting gun has just been fired. Don't walk. Run to your bank and see what kind of deal you can get. Now we're talking my language. Stocks, equities, the greatest wealth creation machine on planet Earth. Rate cuts are like a steroid shot for the stock market. Why? Two simple reasons. First, as we've discussed, it makes businesses more profitable. Lower borrowing costs mean fatter bottom lines, and fatter bottom lines mean higher stock prices. It's not rocket science, it's mad money science. The whole market gets a lift from this rising tide of optimism and cheap capital. But here's the pro tip, the inside scoop. You have to look at the interest rate sensitive sectors. I'm talking about real estate companies, automobile manufacturers, and banking stocks themselves. These are the companies that benefit the most, the fastest. Their borrowing costs plummet, and demand for their products, houses, cars, and loans explodes. These stocks don't just rise, they launch into orbit. This is where you find the multi-baggers. This is where you can make some serious, life-changing money if you do your homework and pick the right horses. Ski douche. Okay, deep breath. It can't all be sunshine and roses. With every great bull market comes a bear lurking in the shadows. And the name of this bear is inflation. When the RBI pumps this much money, this much liquidity, into the system, and everyone starts spending, what happens? Too much money starts chasing too few goods. The price of everything starts to creep up. Your vegetables, your petrol, your rent. Suddenly your rupee doesn't go as far as it used to. This is the dark side of the rate cut. It's a necessary evil, a trade-off the RBI is willing to make to spur growth. But for the saver, for the person who keeps their money in a simple savings account, it's a disaster. Inflation is a silent thief in the night that erodes the value of your hard-earned cash. That 100 rupee note in your pocket might still be a 100 rupee note next year, but it will buy you less. This is a red flag, a warning siren. You cannot be complacent when inflation is on the prowl. This is a crucial concept, so listen carefully. This is where amateurs get wiped out and pros get rich. You're going to see your investments going up. Your stock portfolio might show a 15% gain. Your mutual fund statement will look fantastic. These are your nominal gains. They look great on paper. You feel like a genius. You're high-fiving everyone at the office. But you have to ask yourself the tough question, what are my real gains? To find your real gain, you have to subtract the rate of inflation from your nominal gain. So if your portfolio is up 15%, but inflation is running at 8%, your real gain is only 7%. See the difference? That's the illusion. The government and the banks want you to focus on the big, flashy, nominal number. But the smart investor, the mad money investor, always adjusts for inflation. Because at the end of the day, it's not about how many rupees you have, it's about what those rupees can buy. Don't be fooled by the mirage of nominal returns. Remember what I said about loans getting cheaper? Well, where do you think a lot of that cheap money is going to go? Straight into bricks and mortar, real estate. With home loans becoming more affordable than ever, everyone who is dreaming of buying a property is going to jump into the market. This sudden surge in demand, fueled by cheap credit, is going to send property prices through the roof. For existing homeowners, this is fantastic news. The value of your asset is about to get a major boost. But for first-time homebuyers, this is a double-edged sword. Yes, your loan is cheaper, but the price of the house itself is going to be significantly higher. It creates a frenzy, a bidding war. Developers will see this demand and start jacking up prices. So while the barrier to credit is lower, the barrier to entry, the actual cost of the property, is about to get a whole lot higher. Be prepared for a heated, expensive market. I'm begging you, please listen to me on this one. If your financial plan is to stash all your cash in fixed deposits and savings accounts, you are walking into a trap, a death trap for your wealth. With the RBI cutting rates, the interest your bank pays you on these deposits is going to get slashed. We're talking paltry returns, maybe 5 to 6% if you're lucky. Now, remember our friend inflation, the silent thief. If inflation is running at 7 or 8% and your FD is giving you 6%, you are losing money. Your real rate of return is negative. You are paying the bank for the privilege of holding your cash while it loses purchasing power every single day. This is financial suicide. In this environment, cash is not king. Cash sitting in a low-yield savings instrument is trash. You have to find assets that can outpace inflation. Relying on FDs right now is like bringing a knife to a gunfight. You're going to get hurt. So, there you have it, the whole playbook. The RBI has dealt the cards, and now it's your turn to play the hand. This is a moment of immense opportunity, but also significant risk. On one hand, the wind is at the back of the stock market, especially for those rate-sensitive sectors we talked about. Real estate is also looking very attractive as an asset class that can beat inflation. This could be a prime time to do your homework, identify quality companies, and maybe even make a move on that property you've been watching. This is a time for action, not for sitting on the sidelines, but, and this is a big but, you must keep your eyes wide open to the inflation monster. It will devour your savings if you let it. Your traditional fixed deposits and savings accounts are now in the danger zone, likely to give you negative real returns. You have to be smarter than that. You need to position your capital in assets that grow faster than prices are rising. This is a fundamental shift in strategy. The old safe playbook of stashing cash in the bank is broken. You need to adapt or you will fall behind. Think about your options. You could look at real estate investment trusts or REITs to get exposure to property without buying a whole building. But frankly, in an inflationary environment like this, I'm a believer in owning the real thing. Owning a piece of land, a tangible asset, can be a powerful hedge. The bottom line is this: be proactive, be smart, and be diversified. The game has changed. Don't get mad, get educated, and go out there and make some money. Booyah!